In this video, I'm going to discuss a statement of affairs, also known as an SOA. An SOA is a statutory form and it's used in liquidation or other insolvency procedures like administration or even a CVA, and it's required under Section 99 of the Insolvency Act. A statement of affairs discloses the company's assets, liabilities, and estimated deficiency, and it's pretty similar to a balance sheet that you'd normally see in a set of accounts. It's the director's responsibility and duty to produce the document, but actually in reality, the proposed liquidator will usually produce that on behalf of the directors based on the information provided to them. So first of all, I'd like to take you through the SOA template, and then once I've done that, I'll take you through some examples to include figures so you get a better understanding of how it works. So the first page, or the cover page, is pretty simple, pretty obvious. States that it's a statement of affairs, states the company's name and number, and what date that the statement of affairs was prepared.
It has to be a maximum of 14 days prior to the liquidation resolutions.
And at least one of the directors will have to sign this statement of truth. If there's more than one directors, they can sign that, or they might sign what's called a statement of concurrence, basically confirming that they agree to the contents of the statement of affairs so there can be no future dispute. So let's start with a summary of assets. This will describe the different categories of assets that the company owns between fixed, floating, and uncharged. So starting with the fixed charge assets, these will typically be things subject to a fixed charge like, for example, a property subject to a mortgage, hire purchase assets covered by hire purchase finance agreements, and book debts that are subject to a factoring agreement. Then you'll see the next row down, we've got assets subject to floating charge. Floating charge is also known as a debenture, and these are assets that don't crystallise until an insolvency event takes place, and therefore the bank or the lender, or basically the floating charge holder, that is normally a bank, but they don't actually have control over those assets. Examples of floating charge assets might be things like debtors, those that aren't covered by a factored agreement, cash, stock, plant and machinery, etc. An easy way to tell whether a company's got fixed or floating charges is to have a look at the record filed at Companies House. And then finally, you've got uncharged assets. So basically, that's anything that isn't covered by the floating charge or fixed charge, or more likely, if there isn't a fixed or floating charge in place, then all of the assets will be classed as uncharged. The next section of the SOA is a summary of liabilities. There's quite a lot of information to squeeze in here. I've shown you the entire page just for information, but as I discuss this now, I'm just going to zoom in on each section so it's easier to see. So we start with moratorium debts. Moratorium is a procedure where the company applies to court in order to obtain some breathing space. It freezes out the creditors from being able to take any action against them because all of its debts are ring-fenced, usually with a view to entering a CVA. And so if for any reason that doesn't happen and the company then enters liquidation or administration within 12 weeks, some of those debts have super priority. Next, we've got your preferential creditors, and there are two different types of preferential creditors. You've got the primary and then secondary. So obviously primary comes first, and primary preferential debts are A, holiday pay owed to employees, and B, wage arrears owed to employees capped at £800 per employee, and then pension contributions capped at the last 12 months. And so usually what happens is, see my other video on this, but the Redundancy Payments Office will step in and pay the employees most, if not all, of the monies that they're owed by the company, and then they will step in their shoes and lodge a claim in the liquidation and split that out between primary preferential and unsecured. And then we've got your secondary preferential creditors, which is basically HM Revenue and Customs. HMRC gains preferential status back in 2020. Their secondary preferential debts include VAT, PAYE, NIC, and CIS deductions. And then we've got what's called the prescribed part. Now, I'll go into more detail on the prescribed part in a different video, but for now, the simplest way to explain it is the law says If you've got some money available to pay to the debenture holder, i.e. the net property, the amount that's available to pay as a dividend back to the floating charge holder, again usually a bank, you must reserve, it's a bit complicated, but loosely 20% of that money must be carried forward and made available for the unsecured creditors. So we're still on liabilities, but move further down the form. After taking the prescribed part out, that's going to leave you with an estimate available for the floating charge debenture holder. And so that's the next figure that will go in. The amount that's owed to the floating charge holder will go in the next part, and that will give you either a deficiency or a surplus available. Then you're going to put back in the amount of the prescribed part that you took out, and that's so that the bank don't get that money that you've reserved for the unsecured creditors. So you've taken the prescribed part out above, worked out how much is available to pay the bank, and then you've brought that prescribed part back down, ready to distribute that amongst the unsecured creditors. And then you've got your unsecured creditors, and that's effectively pretty much everybody else that isn't secured, fixed, floating, prescribed part type creditor. So you've got your employees, anybody that still owed money for notice pay, redundancy, the balance of wages above the £800 if that wasn't a primary preferential debt. Again, the RPO usually steps in the employee's shoes and puts the claim in for those monies that they've paid out. Then you'll have consumers. Those are creditors, effectively customers that have paid in advance for goods or a service. So usually they've paid a deposit. Sometimes they might have paid in full and they haven't actually received that service.
In a perfect world, customer deposits should have been protected by the directors by paying those monies into a separate client account, but that's also a subject for another day.
And then you've got all your unsecured creditors. Everybody gets mixed in together in one big sum. And finally, at the very bottom, you're going to have any issued and called up capital, i.e. how much money is owed to those shareholders. And so once the form's been filled in correctly, the figure at the bottom should be the company's deficiency, give you an idea of the extent of its insolvency. If that figure is actually a surplus, that would be quite rare and unusual, because the company wouldn't normally be going into liquidation if it's solvent, so you wouldn't expect it to have a solvent balance sheet or statement of affairs. And then after all the exciting sexy stuff, we have the schedules for the company creditors, schedules for the employees, schedules for the consumer creditors, those are those deposit customers that I mentioned, and schedules for the company shareholders. So now I'm going to whiz through some examples with some actual figures in based on some SOAs I've downloaded from Companies House at random. So this first one is nice and simple. You can see at the top, assets subject to fixed charge, there aren't any. Subject to floating charge, there aren't any. Uncharged assets is literally just book debts, and that's customers that owe the company money. They're called debtors, not to be confused with creditors, which is easily done. They're the opposite. They're the people that company owes money to. And so in this case, the book value, which is the value written down in the company's accounts, is 6,700, and then the estimate to realise, that's how much the directors think the liquidators will be able to realise when they've collected in that asset. So here you can see they expect to collect in 100% of those book debts, so they all seem good, and therefore the total assets are going to be £6,700. And so moving on to the liabilities page, we can see at the top that 6,700 estimate for the assets has been brought forward from the assets page, and that gives us our starting figure. There are no preferential creditors in this case. There are no floating charge holders in this case, and therefore total assets available for the unsecured creditors are £6,700. We have a little look at those unsecured creditors there. We've got some employees. That must either be for redundancy or notice pay. HM Revenue and Customs, 35,000, that's the bulk of the debt, and then there's a connected creditor. So probably maybe the director might be owed some money, or another entity connected to them. So the company's total debts are just shy of 39,000, but again, you'll see the majority of that debt all relates to HMRC. So I would suspect, just from purely having a quick look at this, that the company's downfall here was that it wasn't able to keep up with its taxes for whatever reason, presumably because it wasn't making enough profit. And then at the bottom, we've got £1 owed to the shareholders. So those shareholders have invested £1 and they've lost it. And then the total deficiency is 32,000. Moving on to the next one, we don't appear to have any assets subject to the fixed charge, no assets subject to the floating charge, and therefore all of the assets are classed as uncharged. So we've got goodwill, plant and machinery, a few debtors there, other debtors. That usually tends to imply that there maybe is an overdrawn director's loan account. And that would also maybe explain why the estimate to realise has been put as uncertain there. But you'll see those total assets add up to 26,000, albeit they don't allow for the estimated debtors because that figure has been left as uncertain in this SOA. And then that figure of 26,000 has been carried forward again to the liabilities page. There are no preferential creditors here, primary preferential creditors that is, but there are secondary preferential creditors because HMRC are at a whacking great 225,000. And again, that would explain why the liquidation, I suspect, has come about here. And then continuing or just finishing off the liabilities page, we've got the unsecured non-preferential creditors. And here we've got a bounce back loan of 30,000. That's unsecured. The government guarantee those loans. They're not personally, the directors are not personally liable to pay them back. So it's classed as an unsecured creditor. And then we've got a very small figure for trade creditors. And so the company's total overall deficiency, after taking into account it owes £10 to its shareholders, are £230,000. And as we can see, the majority of that all relates to HM Revenue and Customs. Moving on to the next one, there are apparently no assets subject to a fixed charge, no assets subject to a floating charge. So all the assets are uncharged. And then just to confuse things slightly, they've described one of the assets as a fixed asset rather than actually explain what it is. So whether that's stock, plant and machinery, motor vehicles or something. Estimate to realise is uncertain. We've got some book debts there, £2,500. They expect that to all be recovered. Some cash, £9,000, and then a rent deposit uncertain, probably because the landlord usually is entitled to offset that against their costs or their rent arrears, which usually means there's very rarely a surplus rent deposit to hand over. And so we've got just under £12,000 worth of assets. And you can see here that that £12,000 has been brought forward. There are no primary preferential creditors, so no employees owed wages or holiday here, but there is money owed yet again to HM Revenue and Customs, just shy of £9,000. So we take that off the 12, we've actually got £3,000 available, no floating charge creditors, therefore no prescribed part, and that means the total available for the unsecured is £3,000. And then the creditors consist of the directors. So the directors have put some money in, 23,000 they're owed, a little bit of trade, and a bounce back loan owed to HMRC. So there's 30,000 of unsecured creditors there. Take off the surplus we've got available, add on the £100 owed to the shareholders, and you've got that deficiency there, £27,500. The next one is another simple one, no fixed or floating charge assets. Everything is classed as uncharged. So we've got some nominal office equipment and computer equipment. Proceeds of a sale, normally expect that to be classed as cash if something's been sold, but perhaps the agents are holding those funds at the time this was done. So that's been recorded as proceeds of cash. £1,000 here. Debtor surplus, again, I wouldn't usually expect that to be called a surplus unless perhaps there were some factored debts and there's sufficient there to cover those or pay those all off in full, pay the factoring company back, and that might have resulted in that small surplus there. And then again, you can see we've got that £20,000 marked as uncertain. So total assets has been classed as £16,000, albeit we've got these uncertain figures included in those assets there. And so we move on to the liabilities page. We've got £16,000 available for those creditors. There are some preferential creditors here, £15,000. So that leaves us with £1,700 available for the secondary preferential creditors, HMRC, PAYE and VAT, £158,000. So again, HMRC are the largest creditor by the looks of it in this liquidation, and probably the main reason why this company has gone pop. So we carry forward all of those figures, and then we've got the unsecured creditors. So these are a whacking great £430,000. So we've got a massive director's loan account there, which would suggest that perhaps the directors have been propping this company up, maybe for longer than they should have been, perhaps. A large liability debt there to the employees, trade creditors are relatively large, and then a bounce back loan. And so, having taken all of these figures into account, there's a deficiency there of almost £600,000. So here's an example of a slightly larger case where there is a fixed and floating charge and some secured creditors. So you can see we've got some goodwill there that's been estimated at just under £250,000, less the amount owed to a bank, which is £375,000. So there's going to be a shortfall there. And then there's another bank that's owed some money, and they've carried that figure down as well, £173,000. And then there's some hire purchase agreements. They've lumped all these together, which is slightly unusual. I'd expect to see each of the HP companies and their assets scheduled out separately, so you can see how much is the surplus or deficiency to each one. But here they've just gone about it and summarised it. So we've got £470,000 worth of assets, but as you can see there, all of these liabilities to come off, and that's actually going to leave a surplus of £122,000. And then we've got assets subject to a floating charge. So that's everything that hasn't been covered by the fixed charge owed to these banks and HP companies. And the main interesting bits there, you've got some motor vehicles, plant and machinery, some trade debtors there. You can see they've obviously allowed for some that they think are bad, going to have to be written off and not collectible for whatever reason. Then we've got some customer contracts. They've been written down, presumably due to the company's insolvency. And then that surplus of 122 has now been carried down here, available for the preferential creditors. So we've now got £500,000 worth of assets that we've brought forward from the previous page. So let's zoom in and have a little look at these liabilities. There are no primary preferential creditors here, but again, HMRC are a secondary preferential creditor for PAY and VAT to the tune of £450,000. That's a whacking great debt there. And then by the time they take the 510 off, we've got £60,000 surplus. And then we've got the prescribed part. So that 14,000 has been calculated on the net property figure available from the 57,000. There will be costs deducted to calculate that net property figure, which I won't bore you with today. But overall, when it comes to statement of affairs, one point to note is they don't take into account the cost of liquidation, and therefore these figures are often misleading. Sometimes they might show that there's going to be a surplus available to creditors when actually there's not, because the costs to the liquidator still have to be taken off those fees and expenses. And so here we've got this prescribed part figure that's been calculated, and we've got this deficiency brought down to the floating charge creditor. 14,000 is brought back in to be made available for those unsecured creditors, and they consist of pension liability, directors' loan accounts. So again, directors are owed quite a large sum here, possibly even propping the company up again. Trade creditors are quite high, and then some other creditors which had identifying names, so I just took those out for these purposes. And so actually you can see here that this particular company's overall deficiency is £823,000. If you're still awake, hopefully you have a better idea of what an SOA is and how it's put together. Don't feel overwhelmed if this is something that you've been asked to produce by your insolvency practitioner. As I said, it's something that they would usually hold your hand and help you with. If you give them the figures, they will slot that together and go through that and explain it with you. If there's anything you don't understand, just ask them.